Hey everyone, in this video I'm going to bring you one dividend stock that's down 53% off its high that I think is an excellent stock to buy heading into 2024. Also, this dividend stock offers passive income investors a dividend yield near 6%. It's also not trading at an expensive valuation. So if you got a stock that's down 53%, offering a 6% dividend yield, trading at a cheap valuation, all of those things I really like about this investment. So let's take a closer look at what this is and more information on why I really like this stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the dividend stock that I'm talking about here is 3M. 3M is down 53% off its high and it's trading at an attractive valuation. Now, I want to take a closer look at some more financial metrics from 3M to really understand why I really like this stock. So I mentioned already it offers an attractive dividend yield of 5.79%. And I have a hunch that 2024 is going to be a good year for dividend stocks. The central bank has indicated it's going to start cutting interest rates in 2024. It's indicated it's going to cut interest rates 3 times. And if the market responds by selling off government bonds, that will reduce the yield that investors can get with government bonds. And so investors looking for passive income might turn to dividend stocks when the government bond yield decreases. Now, this is just speculation on my part, but it has foundation based on the central bank decreasing its interest rate, which is something that passive income investors have had a strong choice, right? That's been, you could have gotten over 5% yield on a 30-year or 20-year government bond at one point with almost zero risk. And so it made it really attractive for passive income investors. Why would you look for dividend stocks when you can just get a government bond that pays you over 5% with zero risk? And so with that option being reduced, it might make dividend stocks more attractive. Now you will note that 3M is a cyclical company. You can see revenue rising and falling over the last 10 years, along with the economic cycle. In the most recent drawdown, however, there was an additional factor bringing down 3M's revenue. And that is that 3M benefited significantly during the pandemic. You wouldn't think of 3M as a pandemic stock, but it did benefit during the pandemic. It also benefits more so when people spend money on goods instead of services. And that's another factor that's bringing 3M's revenue down in the recent year and a half. People have been spending more money on services. And so that's decreased demand for 3M's products. However, that's a short-term issue. That's a short-term issue. Longer term, the balance between goods and services is going to revert back to the long run trend line once people get this pent up demand out of their system. There is still pent up demand for people to experience away from home activities, things like travel, theme parks, concerts, movies, etc., etc. Those are in high demand right now because we were locked up at home for something like 3 years. And so people want to make up for that. They really want to experience that. But longer term, it's going to go back to a normal dispersion between goods and services, right? This short term makeup is going to last, estimates suggest, throughout 2024. And then starting 2025, the estimates suggest a more normalized level of consumer spending. And that's where 3M is going to benefit from that reversal of this downtrend. Longer term, 3M has done an excellent job of turning sales into cash flow. The sales from cash flow to operations ratio reached 20.02% in the most recent trailing 12-month period, and it has fluctuated around this number longer term over the last decade. It's about right at the average. It's been higher and it's been lower, but about 20% is the average if you look across the last decade. And I feel that's a sustainable level for 3M to achieve longer term as well. Now, we mentioned already that 3M's business is experiencing a decline, and management has responded by a significant several billion-dollar cost-cutting initiative, and already it's starting to show up in the employee count. You could see here 3M had employee count approaching 100,000 in 2020, and that's been dropped nicely to 92,000. So the company is cutting costs to deal with this lower demand environment that's likely to last for at least another year. And so I'm liking 3M taking these cost-cutting measures, trimming down some of the excess, and so when the recovery happens, it can be more profitable. Speaking of the recovery, let's look at the estimates. So according to analyst consensus estimates, 3M's revenue is likely to grow by 2.9% in 2024, with earnings per share growth of 7.5%. Similarly, in 2025, the company is expected to grow revenue at 3%, with earnings per share to grow 7.5%. And to me, for a company like 3M, these would be excellent results. Investors don't expect a company like 3M at its mature stage as it is right now to grow much faster than the low to mid single digits, right? A 5% growth rate for 3M would be phenomenal, right? This isn't a fast growing company. This is not what you invest in 3M for. But you could see the company growing 7.5% earnings per share with just 3% revenue growth. And that's what you can expect from 3M, for them to every year get a little bit better at what they do, get a little bit more efficient at what they do, and deliver solid, close to double-digit earnings per share growth with low single-digit revenue growth. So let's look at the balance sheet now with 3M and cash and short-term investments of $5.21 billion and long-term debt of $16 billion. The company is a bit leveraged at the moment. This especially makes me a little bit uncomfortable with 3M considering the legal issues it's facing. It's no secret by now, if you're looking at 3M stock, you know of the legal issue it has. It's being sued and could end up liable for several billions of dollars from these legal actions. And with that being the case, I would have preferred 3M to have a stronger balance sheet in case it does end up having to pay those expenses if it loses and those outcomes of those court cases are negative. I would have liked to have seen a stronger balance sheet. So this is one thing I'm not thrilled about 3M right now. Finally, I mentioned how 3M stock is not expensive. It's trading at a forward price to earnings of 10.57. That's a cheaper valuation than the average stock in the S&P 500, which is trading at a forward price to earnings between 16 and 20. And with 3M expected to deliver 7.5% earnings growth in 2024 and 7.5% earnings growth in 2025, and I would suspect around that level of earnings growth longer term, I think at current valuations, 3M is an excellent dividend stock to buy heading into 2024. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.